I'm going to demonstrate how to calculate the financial analysis ratios for Apple in 2020. Our textbook showed 2019, and I'm going to show you how to do it in 2020. So if you go to the annual report that they file with the Securities and Exchange Commission, this is the Form 10-K. That's the annual filing that publicly traded companies have to make with the SEC. And so here we can see it's for the fiscal year ended September 26, 2020. And then if you scroll down, you can get to the table of contents. Okay. And so here's that management's discussion and analysis of financial condition and results of operations that's talked about in the chapter. And by the way, you could just get to this. You can just do an internet search to find this. Okay, it's available to anyone. We're going to be going to the financial statements and supplementary data to do our financial analysis. So I'm going to go right there. And so here's all of the financial statements. So the consolidated statements of operations, this is the income statement, right? And we recognize this, our sales, our cost of goods sold, our cost of sales, gross margin and gross profit mean the same thing. So there's our multiple step income statement. Okay. You'll learn about this in an advanced accounting class if you're going on in accounting. Here's the balance sheet that we're used to: assets, current assets, long-term, liabilities, stockholders' equity. Okay. And then instead of just showing the changes in the retained earnings, right, beginning balance, net income, dividends, okay, and coming down to the ending balance, there's a few more complicated things in here we'll talk about when we get to our stockholders' equity chapter. Some of it you'll learn in a more advanced accounting class. But instead of just showing the changes in retained earnings, the statement of stockholders' equity shows the changes in our other stockholders' equity accounts that we cover in the stockholders' equity chapter. And then our very last chapter is going to be covering the statement of cash flow. So you will learn this before you finish the course. After the statement of cash flows is notes. So additional information that you need to provide to the readers, the users of your financial statements, so that they can get a full picture of what's going on with your company. Okay, so that's also referred to in our chapter. So we're going to start off, we're going to calculate the ratios for the liquidity. And here, let me go back to the financial statements. So the first thing we want to calculate is working capital, right? We use our current assets to pay off our current liabilities, and our working capital, it's what's left over. So we want to go to the balance sheet. So when we go to Apple's balance sheet, here we go, we can see the current assets are $143,713. The current liabilities are $105,392. So when we divide, working capital we subtract, and we can see after we use our current assets to pay off our current liabilities, we're still going to have we're still going to have $38,321. Okay, and so you can compare that. If you look in our textbook, it shows the 2019. We can see trends. You can compare this to a competitor company to see. We want to have enough on hand to obviously cover our current liabilities, have some left over, meet unexpected needs, but we don't want to have a whole lot sitting here because we won't be earning interest or dividends on that money that's just sitting here in working capital. Related to working capital is the current ratio. This is where we divide current assets divided by current liabilities. And we can see how many times our current assets cover our current liabilities. So when we divide, we see the current assets by the current liabilities. We see the current assets cover the current liabilities 1.36 times. Okay. And so again, compare that to a competitor. So we can cover it. There's a little bit left over, but not a whole lot. Sometimes, depending on the industry, the guideline says they want a current ratio of 2. And sometimes the bank will call a loan if your current ratio falls below 2. So you have to be familiar with what is standard, what's acceptable in the industry. But it's also helpful to do the intra-company comparison as well as compare to a competitor, which you're going to do in your assignment. The next ratio we're going to look at is the acid test ratio. So we're going to be refining this analysis a little bit further and not just looking at using all of our current assets to pay our current liabilities. We're looking at our most liquid assets, that the ones that are going to be most quickly converted into cash. How many times do those cover our current liabilities? So instead of looking at all of our current assets, we're going to look at cash, right? Because that's already there to pay our current liabilities. Short-term investments, we can sell those off quickly and cover current liabilities. And receivables, we're likely going to be getting them, depending on your credit terms, maybe in the next 30 days, right? So those are going to be turning into cash very soon. So we add these together and get our total quick assets and divide that by current liabilities. So if we go and look at Apple, on their balance sheet, we can see cash and cash equivalents, $38,016. Marketable securities, these are short-term investments. Okay. And then we've got our accounts receivable. So we're going to add the three of those together and then divide that by your total current liabilities. So here, that's the current liabilities. The result, I added together. So we summed it and we came to a total before we divided by the current liabilities. So 1.02. So even if they can't sell off their inventory, they can still cover all of their current liabilities. Okay, so a benchmark is typically 1. If that's our guideline, is typically you want a current ratio of 1. Okay, but again, that's industry dependent. So you compare this to your competitor, you can compare this to yourself in previous years, but we're at least meeting the guideline for this one. The last liquidity ratio we're going to look at is the total asset turnover. How many times does our sales cover our average assets? So we have to go to the income statement to get the sales, and then we have to go to the balance sheet and get the beginning and the ending total assets numbers. So here we are on our income statement. They're calling that the statement of operations. We see our net sales are $274,515. And then to get your average total assets, here we can see the total assets. We're going to take last year's ending as this year's beginning. So we're going to take the $338,516, add it to the $323,888, come to a subtotal and divide by 2. Common mistake I see is sometimes students use the current asset number. Right? We want the total asset number. So here you can see adding together, I've got the parentheses around them. So I'm adding it together, getting a subtotal before that gets divided by 2. Okay. That comes to 331,202. That was in between the beginning, 323, and the ending, 338, right? It falls in between. So when we divide, we can see that the net sales doesn't cover the assets even one time. It's only 0.83. Okay, so we compare that. I think we saw in the chapter the industry average was 1.1 for the industry. So we fall short of the industry, but the competitors, at least in 2019, were lower than Apple, even though Apple was lower than the industry. Next, we're going to look at the solvency ratios, which show the company's ability to pay their long-term debt and generate revenue long-term. Right, so this is kind of an indicator of long-term survival. So we're going to look at 2 ratios. The first one is the debt ratio. We take the total liabilities and divide by the total assets. That tells us what % of the assets are financed by debt. So here we come to the balance sheet. The total liabilities are given to us as a line item. We're going to divide that by the total assets. Sometimes, though, they give you the total current liabilities depending on the company you're looking at, and then they just list the long-term beneath it. And they never come to a total liabilities. They just come down to total liabilities and shareholders' equity. Well, you can back into your total liabilities if you know your total liabilities and shareholders' equity, and you know your shareholders or stockholders' equity. You're going to subtract. The difference is going to be your total liability. So depending on the company you're analyzing, you may have to kind of back into the liabilities number. It might not be clearly labeled on the balance sheet. For Apple, it is. So we're dividing 258,549 by 323,888. And so when we divide, okay, we're going to see the result almost 80% financed by debt. And so I've talked about in the lecture videos that debt isn't bad, but when the debt gets high, it becomes riskier and it may cost you more to borrow. You may be charged a higher interest rate. So this is getting a bit high, but compared to a competitor, to kind of gauge where you're at, it may be, more standard to have a higher debt ratio depending on the industry. The other solvency ratio that we are going to look at is the times interest earned. How many times do our earnings cover our interest expense, right? How many times over would we be able to pay our interest expense? Because our long-term creditors want to see that we will be able to meet our interest obligations as they come up over the term of the long-term loans. So we take our income before interest expense and income taxes. Okay? And then we're going to divide that by the interest expense. So we come to our statement of operations, our income statement, to get these numbers. And so we don't have a line income before interest and taxes. We can see the operating income, and then we can see we actually ended up, the other revenue was more than the other expense. It got added to get to our income before taxes. So our textbook says we can get there. There's a couple ways we can get there, but the textbook says we take our net income, add back the income taxes, add back the interest expense. Well, we don't know how much of this is interest expense. It's a positive number, so obviously our other revenue was more than our other expenses. So we need to go to the notes and find where the breakdown of this 803 is given. So here we can see the breakdown of the other income expense. And so we can see in 2020, the interest expense was $2,873. Our interest and dividends were more than our other expenses. That's why this is a positive number. So to get to our income before interest and taxes, we're going to take our net income. We're going to add back our taxes of $9,680, and then we're going to add back that interest number that we got when we looked at the 803, $2,873. So the net income plus the interest expense plus the income taxes gives us our income before interest expense and income taxes, $69,964. We divide that by that interest expense number, and we can see that we have enough earnings to cover our interest expense 24.35 times. So that's even higher than what we could do in 2019 compared to your competitors. The guideline in the textbook says at least 2, so we are in good shape on this one. Our long-term creditors, they don't feel that this is going to be risky when they see this result.